Right, so is it time to give up on the market yet? The S&P 500 is down close to 20% this year. And inflation is at its highest ever over the past decade. And that's despite constant rate hike by the US Federal Reserve. Companies are also starting to lay off their employees to prepare for a market downturn. There does not seem to be any positive news in the market right now, and investors are edging closer and closer to full panic mode. Yet, Warren Buffett has also reminded us that we should be greedy when others are fearful. After all, wealth is created only when we can be contrarian in the stock market. So, is this volatile market the opportunity that you are waiting for? But before we rush into buying any stock, we must maybe first prepare ourselves of what could be ahead of us. This is because it is so easy to say words like be greedy when others are fearful, but to truly perform the deed is harder than you think. This is because when the market falls into full panic mode, we have to ensure that we ourselves are not panicking. And a market downturn can be very scary to all of us. With a slowdown in economic activity, this could lead to businesses laying off more workers. And the wealth of people will also decline and people will start tightening their spending. This then will lead to lower demand in goods and services, making businesses suffer even more. So company might start to report lower earnings. And as valuation of stocks tend to have a relationship with company earnings, as earning falls, stock prices might fall even more. And if that fall is severe, it could very easily spread to other asset classes as well, like bonds, commodities, and even cryptocurrency. And this is pretty much what we have been experiencing over the past 12 months. But the good news is that market downturn comes and go. And so far, the world has been able to recover from every single one of them. Over the past few decades, there have been market downturn almost every 8 to 10 years. And each of those can last up to 1 to 2 years themselves. So as investor, it is impossible for us to know when a market downturn will start or end. But during a recovery, it is always better for us to be invested in the market so as to take advantage of the stock market rally. However, if that is the case, how can we best decide which stock or sector to focus on? Well, after reviewing all major sectors across the US and the Asian market, today I'm going to share with you 3 sectors that looks interesting to me. But before we talk about that, I'd like to thank my sponsor for this video, FSM1.com. Of course, these 3 sectors of interest that I'm going to share with you are just my personal view. But if you want to learn more about other sectors of interest for next year, you can also visit FSM1.com annual flagship event, the FSN Invest Expo. It is going to be held on 7 January at Suntec Convention Center Hall 403. And you can register and join them live and in person to hear from their lineup of speakers and industrial experts as they share on how many more sectors that they are interested in for 2023. On top of that, you get to participate in several fun activities as well that help you learn about investing and also, more importantly, win some of their 15,000 worth of prizes up for grabs that day. So remember to check them out at the link below. Now, let's get back to our video. Number 1. The Chinese financial. Financial companies dominate the undervalued category within the Hong Kong stock market. Most, if not all, of the financial companies right now are trading below their book value, and many are giving out very generous dividends. But most of the large financial companies on the Hong Kong Stock Exchange have actually been giving out consistent dividend over many years in the past decade. But looking at their valuation, it seems that investors are almost expecting some of these companies to be facing bankruptcy risk. Of course, I think much of it has to do with the mainstream media report on Chinese property sector that has led to many defaults in mortgages. But my view is that this crisis might not be as big as most media report paint it to be. And since the loan-to-value ratio in China is relatively low compared to the rest of the world, the banks are actually quite well protected in their loans, even if we start seeing default rate increases. However, the overall sentiment of this bank among investors are still very, very weak. The financial performance of these major banks have actually been improving over the past 5 years. And yet, from the stock market, we can see that the valuation of this stock have continued to decline. My view is that most of the global funds are dominated by US-based fund houses. And because of the political crisis between the US and China, that become a key factor for them to consider when investing in Chinese stocks. And regardless of how cheap this Chinese financial institution might be, the political risk might be too high for them to invest at all. And this fund will disregard this market completely. And so without the interest coming from foreign investors, and Chinese domestic investors can invest in the same company from their local A or B shares, there's no real catalyst for Hong Kong listed financial companies to recover their valuation. Hence, I think that's why they have stayed at a very depressed level for many, many years. That might also be the reason why we are seeing even a difference between bank valuation of the same company between the Hong Kong market and the Chinese domestic market. Yet, having said that, if you are a dividend investor, you can still get a very decent cash flow return from this investment going forward. Some of the banks are giving dividend yield close to 10% right now. But more importantly, there might be some good news in the horizon for these Chinese banks. For now, China is finally reopening their economy. And if the economy can start to grow again, that's basically good news for the banks. And apart from that, we have also seen in the past few years, the Chinese government has been adding more regulation for fintech in the country. This will maybe slow down the rate of disruption to the Chinese banking sector, which again is generally good for the traditional banks. Overall, I think this sector is a very interesting sector to watch. Number 2, technology. Well, the Nasdaq index have experienced a huge drop, more than 30% this year. And many of the famous tech companies like Meta Platform, PayPal, Shopify have seen their stock prices drop more than 70% to date. All of these has led to some of the lowest valuation ever recorded for these tech companies. Yet fundamentally, many of these companies are still doing pretty okay. Most of them have very strong balance sheet that could sustain the business during a downturn. Say for example, company like Salesforce and Adobe has very recurring revenue base on their business model. And moreover, the long-term trend for technology is still looking very bright. So if you're searching for stock with long-term potential, this group of stock is something that maybe you should watch as well. And lastly, ESG stocks. Socially responsible investing has really started off around the 2010 era. Since then, more and more investors are focused on not just how profitable a company is, but also how the company did with aspect of its business with regard to environmental, social, and governance issue. It has to do with how a corporate interact with the environment, their community, their employees, and also their supply chain. And this trend doesn't seem to be stopping anytime soon. In fact, apart from institutional funds, financial companies like banks are also focusing more on tying up their loan requirement with ESG targets. So company would maybe even need to meet this ESG target in order to get a loan approved. Therefore, company would need to place more and more focus on this issue, no matter what they do in the future. Today, among institutional investors, there are more than 40 trillion of asset under management labeled as ESG focus. That number is expected to raise to more than 50 trillion by the next few years. Therefore, if you are looking for a growing sector, this is also one for you to watch. Anyway, thank you, and if you've gotten value from this video, please give us a like and share it with a friend who might benefit from it as well. And of course, these 3 sectors are just my own personal view. If you want to learn more about other sectors of interest for next year, you will want to visit FSN1.com annual flagship event, the FSN Invest Expo. It's going to be held again at 7th of January at Suntec Convention Centre, Hall 403. You can register and join them live and in person to listen to their speakers and industrial experts as they share more about what to position your portfolio for 2023. On top of that, remember that you can also participate in many fun activities and up to 15,000 worth of prizes up for grabs that day. So remember to check them out and register for your ticket right now. Anyway, as always, my name is Stanley. Till we meet again, investively.